No, because things go wrong, and then you just have to chop it and go back and think again. Do you know what I mean? Things do go wrong. They don't pan out as you thought. You know, you can have all your strategy worked out and your parameters and your stop losses and targets and all the rest of it, and then suddenly you'll see either a whole huge thing goes wrong and you say, no, I've got to rethink this completely. Or sometimes you're seeing all these little things that are not quite right. And so all the time you're adjusting, you know, and questioning yourself and so on. And so, no. The one thing I would avoid, though, is this concept of smash and grab, that you're going to just dive into the market for a cool 5-10 minutes, you're going to pick up a pot of gold and come out and thinking you're Superman. Forget it. Sooner or later, you will crash and burn. So that is the one thing I would avoid. But everything else is constant, sometimes massive adjustments, sometimes small adjustments in expectations, in tactics, in everything you do in trading. It's constantly evolving. All the time you're monitoring performance and seeing if it's going to plan.
I mean, does that go for this sort of trade duration and trading frequency as well then?
I'd say so, yeah. It varies very much. I mean, I've got some trades. If I'm doing well on certain things, I'm quite happy to stick with a view for years. In terms of, you know, whether currency appreciation or interest rate moves or stock market moves. And you can see that we've certainly had those. I mean, most stock markets have been rallying since 2012 and some since 2009. So, do you know what I mean? Here we are in 2015. You've had some really significant and steady trends that would have given you great opportunities to make investment returns. I would describe those as investment returns, and certainly I've been involved in some of those. In terms of foreign exchange, you have seen some very big moves, certainly over the last 7 months, not only in the obvious candidates like the euro, you know, but you know, in all sorts of different currencies, including Asian currencies and emerging market currencies. Those tend to be shorter term and are more likely to reverse. So for those, I'd say think more in terms of a 6-month horizon being probably some of the longest that you're going to see, longest, and then within that, you know, you're going to be looking at things. And then in terms of commodities, which I love as well, I've been a great fan of commodity futures from the word go. Those also tend to be shorter in terms of their longevity. They'll have the other thing about markets is that they work in like a fractal, so you'll have subsets of a bigger set. So it's a bit like broccoli, where each little lump of broccoli is like a microcosm of the head of broccoli, or like a tree in its branches, right? That markets are very, very fractal. And so depending on your time horizon, you will see the smaller trends within a much longer term trend, and you will go for that time frame. And that, I'd say, is probably about 2 weeks to a month. And then intraday, you've got great also opportunities intraday, I've noticed, and it's to do with the 24-hour time horizon. Shall we say there's a dead period. There's a lot of markets are dead-ish. I mean, foreign exchange never closes, but it's pretty dead between the New York close, which is 5 p.m. New York time, although there are a few people trading in San Francisco and Los Angeles, but they're pretty much irrelevant. And then absolutely nothing happens until Wellington comes in New Zealand and Sydney. But really the market only kicks off with Tokyo. When Tokyo comes in, then you start the day. And then all sorts of people, because there's more liquidity and depth, you decide what you're going to do. You say, right, I'm up, I'm running, you know, things aren't going to plan, I'm going to do this, this, that and the other. And so then you see the market picking up. It sort of reaches a sort of semi-crescendo as London and Paris and Frankfurt come in, which is about, depending on the market, between 7 a.m. and 8 p.m. local time. And then it all goes dead again, and so you've got another big lull where an awful lot of people are tempted to go out for a very long lunch. But that's not a good idea, not a good idea. And then it picks up again usually with US data, which starts being released at 13:30 GMT. And so you have another surge in business activity. So for a day trader, it's very, very important to remember where your surges are and where things are likely to reach some kind of interim crescendo and then pull back. Or reach some kind of an abyss and then pull back. And those sort of times are well worth looking into in terms of trading strategies.
What's the average leverage that you normally use and a maximum?
As little as possible. I'm very, very conservative. When I'm working in the cash market, obviously it's cash. In the derivatives, obviously we have a certain amount of leverage depending on what the initial margin is. But I mean, we just go to industry standards, really. In terms of my own personal trading, it's only money that I can afford to lose. I really do not believe that you should risk stuff that you just don't have. And it's not just in trading, it's in everything. You know, only buy the house that you can afford. Only buy the car if you can afford it after you've paid off all the other bills that are piling up in the drawer that you don't want to look at. It's not a good idea.